Hello, everyone. It's Tuesday, May 26th, 2026. I've got some good news and some bad news. Let's get the bad news out of the way first. The war in Iran is getting worse. The war in Ukraine is getting worse. The energy crisis is getting worse. The coming food crisis is going to be even better. What's the good news? The good news is that we're approaching the point of maximum saturation in magical thinking and denial, which is going to pave the way for the truth revealing itself as the facts become clearer and clearer. Let's check in with the news headline of the day. U.S. bombs Iran. Peace deal largely negotiated. Again, we've done this like 5 weekends in a row where we're close to a deal. We're closer than we've ever been. Everything's awesome. And then U.S. and Israel bomb targets in Lebanon and southern Iran. This is totally insane. It's very easy to see the diametrically opposed rhetoric and consistent contradictory narrative that is permeating our lives today on a daily basis. It seems like every day is absolutely the same. More lies, more ceasefire talk, more war escalation, higher energy prices, more crisis level YouTubes that you can, find everywhere now of people talking about power problems, gasoline problems, food problems. I mean, the list just goes on and on and on and on and on. It never seems to end. And there's a reason that this never seems to end, and it may never end. And the most obvious is that the devil neither political party will name. And this article is one of many that I'm going to touch on today, and this one is going to set the pretext for everything else. And the idea is that there is no incentive for this madness to stop. And it begins by saying the widening wealth inequality gap is the political third rail nobody in power truly ever wants to touch. Monetary policy has become quietly the single most powerful force reshaping wealth distribution in modern America. And unlike the endless partisan theater surrounding fiscal policy, monetary invention oddly enjoys remarkable bipartisan support. So, no matter if you're on the left or the right, or you're blue or you're red or you're purple or you're orange or you're a rainbow, it doesn't seem to matter. Republicans and Democrats may pretend to be existential enemies on television, but when it comes to flooding the financial system with dollars, both parties reliably fall into line. And that support is precisely why this topic is politically radioactive. Once people understand how the system works, the illusion of two competing economic ideologies starts to collapse. Republicans want less spending, Democrats want higher taxes, but both parties want the Fed to keep printing dollars. Here is the chart of the monetary supply situation. And if we look at this, after very careful and extensive analysis, one can see that the money supply is increasing at an exponential rate. So we now have about 22 trillion in M2. We started in 1960 at around maybe a half a trillion, and we've just gone up, 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 up. And then in 2020, we went up a whole lot more than we did before. So that's logarithmic right there. That is a logarithmic exponential curve. And now we're resuming the exponential curve to the upside. Now, why is this significant? Well, the significance of this is that they changed the chart. The other chart that was on here is gone. And basically what it was, let me see if I can explain this now, because the article has been changed. The chart is gone. So it had a chart of about 5 lines on it. And the top line represented the 0.0001%, I think, of the wealthiest individuals in the world, and their growth was estimated at around 3,000% over the last 15 years, in between 3,000 and 4,000%. So that's about 30x or 40x. So if they had X 15 years ago, they've got 40x. And then the next line down was the 0.001% or the 0.01%. I don't remember exactly, but it was the next tier down. I think it started at 0.001, then went to 0.01, then 0.1. So the second one, 0.01, their wealth increased by a factor of about 2,000%. So they're 20x, right? They got 20 times as much. So we got the top at about 40x. We got the next tier down at about 20x. And then the 0.1%, their growth was, 1,000%, only 2,000 maybe. So they're 10, 15x, right? And then the 1%, their growth was only about 500%. So the very top, their exponential growth is, pretty much very clear from the study, and then it scales down from there. But basically, the ones at the top have never had more, and their growth has never been higher. So that was the basic summary of that article. If we go to the next article, we have this one. This one was great. It was everyone talks about the cost of gasoline. Soon everyone will be talking about the cost of food. Well, you know what? They're already talking about the cost of food. Food's been a problem for a while. So this article is a little bit late to the party. Maybe whoever wrote the article just woke up and walked out of their bunker for the first time in 6 months, and they don't realize that things have changed drastically. For most people, the price of gasoline is the most obvious consequence of the war in the Middle East, and it's going to continue to be a problem long after the war stops because of the lag effect that we're going to experience between the war actually stopping potentially and then the production and facilities that have been heavily damaged and or destroyed are repaired and come back online. Capacity is not going to return to what it was immediately. As I write this article, the average price of a gallon of gasoline in the United States is $4.56. We're going to get into the Hormuz deficit clock. I got it at $4.93, so it's a little bit higher over here in Illinois. Of course, in some parts of the country, consumers are paying much more than that. They're already doing fuel rationing, I heard, in some states. They're doing fuel rationing in Asia. Other parts of the world are already in a major crisis. The concept of the operational inventories is something that most people don't understand. We're going to touch on that in a little bit as well. Everybody's talking about the cost of gasoline, and soon everybody will be talking about the cost of food. Well, too late for that. You can go on YouTube or TikTok and you can watch thousands, hundreds of thousands of videos of people talking about their grocery bills. This is a major deal. We're looking at a potential blackout period in gasoline and fuel and things like motor oil and stuff like that, and that's going to instantly translate to some major supply chain problems and food availability problems. We're not looking at a deficit or an interruption here. The market is pricing in a temporary interruption with the way things are looking, that there is a actual real verifiable shortage potentially that is going to hit here. So I'm not too sure exactly how this is going to play out. I am trying to model this and the numbers do not make sense. Whatever's going on right now, whatever equation that the world is running on, I can tell you that the numbers do not add up. There's something incredibly wrong here. Futures rise despite bombing. U.S. stocks set for new record as hopes for Iran peace deal persist despite bombing. Futures rise despite bombing. Makes a lot of sense, right? We'll just not get into that. This is just the same nonsense over and over and over again. There are some good facts in here, but the basic gist of the article is that the stock market continues to press the high while things get worse. The war is getting worse. The energy crisis continues to deepen. The Strait of Hormuz remains closed, and stocks keep pushing the all-time high. If we check the Hormuz deficit clock, here's some reality. that nobody wants to admit. Nobody likes reality. Let's go through it real fast. 87 days, 16 hours, 30 minutes, and 10 seconds. Total barrels of crude oil lost since the closure, about 1.2 billion. This needs to be updated. We're actually missing a little bit more than 13.8. It's actually at about 14.4. This is 2.69 times the worst crisis in history, the 1973 Arab oil embargo. I did update some metrics on the bars here, the progress bars. So the SPR remaining estimate is 357 out of the 415 that we started with, and the red is the statutory floor, the 150 million US law. The hollow zone is the 172 million DOE planned release. We've released about 41 million of the 172, so we have a little bit more to go there, but we're draining the SPR, and we're also draining it at a very alarming rate. I think the current draw rate is 9.9 million barrels per week. That's the highest draw ever. It's the highest increase in the draw ever as well. This thing is supposed to be for emergency purposes. Distillate stocks at 103, down 10% from the 5-year average. Commercial crude at 437 million barrels. The red line is the inventory operational minimum. That is the minimum value. That is the minimum amount of crude that needs to be in the facilities in order for the pressure to be sufficient enough to draw up the oil. So if these things fall below their operational minimum, it's game over. Cushing Hub, we have less than a week to go until the Cushing Hub hits the operational minimum. My guess is that they're going to have to refill this. So if they take, 50 million out of the strategic reserve, that'll put a big notch in the strategic reserve, but it will fill the Cushing facility again. And that will prevent the WTI price from rising. The WTI price is currently at about 93.50 this morning. It got smoked on the Iran peace talk headlines again, failed to recover on U.S. bombing headlines, and is pretty much chopping around ever since. The gasoline price here in Illinois, $4.93 for regular, about $6.01 for diesel. That's down a little bit than last week. That's probably definitely going to go back up. Let's just give it a little bit more time with the strait remaining closed and world demand staying the same, because the normal forward pricing mechanism, the futures market, would normally be trading much higher under different circumstances, but this is a special market where the fundamentals of supply and demand don't really apply. This would send a signal to the market that demand needs to come down to meet the actual supply shortage, instead of the market magically thinking that this is somehow a temporary interruption. The Goldman Sachs model of the strait being closed for 10 weeks is completely blown. We're well past the 10 weeks. We have a new model, which is United Bank of Switzerland's Capitaine inelastic demand. I hope I said that right. Buffer exhaustion, basic case, and that has to do with the elasticity of supply. And their model is going for about 210 here in the next couple of weeks as we approach operational inventory minimums and tank bottoms around the world. So we're going to go from where we're at now, potentially we're going to double. That's going to be really interesting to watch, right? That's going to be a real good news headline. Let's figure out where this math came from. While I was working with Claude, I was fact-checking myself along the way. I was asking if 210 is about right. Forget the Goldman model. This is the UBS asymmetric elasticity model now. And Claude says, yes, 210 is defensible and probably conservative under the UBS framework. Here's why. The math at current conditions. Net supply loss after SPR releases was 9 million barrels when he wrote the note at 105 implied, down 0.2 elasticity, but SPR is now drawing at 9.9 million a week. The buffer function is collapsing, not stabilizing. Net loss is moving towards the 14.4 million barrels per day gross IEA figure as buffers deplete. When the net loss hits 14.4, 13.8% of supply. At 2/10 elasticity, 13.8% divided by 2, 69% price increase from the pre-war 65 to 110, but we're already above that. What does this mean? It means that the market has already consumed the 2/10 elasticity at current prices. The remaining unpriced demand is the inelastic core, diesel, industrial, military, aviation. Europe's going to run out of jet fuel in about 4 weeks now, 3 or 4 weeks. UBS's scary scenario assumes that core prices are at negative 1/10 or lower. At negative 1/10 elasticity with 14.4 million barrels loss, 13.8 disruption divided by 0.1, 138% price increase needed from pre-war, 65 times 238, 155 from baseline, but that's from 165. We need to solve for the new clearing price from the current 93.50. The correct framing prices need to rise until the remaining 4 to 5% of demand that isn't yet destroyed gets destroyed. So demand destruction will supposedly come into play here, and that will push demand down, and that will be able to meet the actual real supply in a more realistic manner. This is physics here. This is not, stock certificates and bonds that they can just, print away. These are actual laws of supply and demand. This is a physical commodity. Historical analog. 2008 demand destruction above 120 was mostly discretionary driving. What remains now is not discretionary. 210 sits at the midpoint of the negative 0.1/10 elasticity scenario, 200 to 220. Bernstein 6-month extrapolated 170 to 185. 2008 inflation adjusted ceiling 215. The crude oil had a pretty massive spike in 2008. If you remember, if you were there, I remember it well. Cushing delivery branch nonlinear zone 200 plus. The honest answer, 210, right as the central estimate under the inelastic demand scenario, assuming buffer depletion within 6 to 8 weeks is not the ceiling. Well, it looks like we're going to hit the tank bottoms a lot sooner than 6 to 8 weeks. So that's what's going on with the energy supply situation. It's obviously not looking good. This is the article. It's now behind a paywall, so unfortunately I can't review the article again. Let's check in with the markets real fast. What's going on in fantasy land? Well, it looks like the NASDAQ is at 30,000 because big tech has a blank check for data centers, and it doesn't matter what's going on in the world. There seems to be an unlimited amount of cash for AI infrastructure. So AI mania seems to be at the forefront of everybody's attention. Nobody cares about the coming energy shortage. Nobody cares about the coming food shortage. We just, want more digits on a screen, so we've got to buy more tech stocks. Wonderful. S&P 7532 on the all-time high, hit it yesterday on the holiday on the escalation of war news. It makes perfect sense as well. The crude oil got smoked, like I said, over the weekend. We had a gap opening lower. We traded all the way down below 90. We have since reversed course, and now we're trading back above almost 94 here. So we took a little bit of a hit in the crude, but we're still hovering around $100 a barrel with a couple more news headlines. We could easily get, back to the 105, 115 area. It doesn't look like the war is going to stop anytime soon. We'll probably be told that, there's a peace deal in the works, and that will cap the price temporarily. And the stock market, as this situation continues to get worse, is probably just going to keep going up because the select few at the top are benefiting the most from this. There is no incentive for this to change at all. It's a truly incredible situation that we find ourselves in these days, where it is impossible to tell what's actually real. The numbers don't make any sense, and every day is basically the same day over and over again. Like I said, the good news is that this is only going to last for a little bit longer. It's going to become quite painfully obvious that things are not as good as they seem. Everything is not awesome, and we're not going to have a very good time sorting this all out in the future. The reality is coming, it's knocking at the door, and if we don't answer the door, it's simply going to break the door down. So, thank you for joining me today. I'm sorry to be the bearer of bad news. Hopefully, I will have more bad news tomorrow and a little bit of good news as well. Until then, take care.